trying to get at is an understanding of what the property market here in South Africa, particularly in the area that you're working of in Johannesburg, why are people struggling to get loans?
It's actually a very good question, and it's one that we always look at ourselves and we always analyze as to why a person is successful with their bond application or not. And the biggest challenge that we find actually in our area, which is Kempton Park on the east end of Gauteng, is that our income bracket of people that we are working with is the low to middle class income. So they earn a consistent salary every month, but because of the pressures of the economy, a lot of those clients are overcommitted. So they may score well in terms of how the bank sees them and their credit rating, but their affordability is the biggest problem. They don't have enough disposable income that's left at the end of the month that allows them to take on a bond as the bank requires. There has to be a certain amount of disposable income. So that's probably the biggest reason why a lot of the clients who are really keen to buy a property aren't successful. But what we've found to overcome that is to take that client and work with that client over a period of months to get them the affordability in the right place, pay off, for example, loans that they don't need or credit that they have that's unnecessary. And that reduces their risk profile and also picks up their credit score, so that when the bank looks at them again, then they actually are favorable. But that would be the biggest reason why most of our clients aren't successful with their bond applications.
So the point you're making is that the disposable income is important.
Yes.
Why is disposable income important for the banks, or why do they focus on disposable income? What is your take on that?
Well, the main reason is the bank wants to be sure that before they lend the money for the bond, that the client has the ability to repay or to manage that credit correctly for the duration of the bond period. So when they look at the client's affordability and they see what the client has applied for, and they can see there's not enough left to cover the bond, then they will either offer a lower amount and the client has to come up with a deposit, or else they will just decline up front. Those are the main reasons.
So in terms of the deposits that are required, is there anything that comes out from conversations with banks that says, if you have this level of deposit, your rate of interest will be this? If you have, do they give some indications? And what are those kind of?
They actually don't give indications as to how the interest rate that they charge, how that equates to the bond that they grant. It's more based on an individual basis on how they assess that client and that client's own particular risk profile. Then they will look at that client and say, okay, we'll give you prime +1 or +2, or even if it's a very good client, they might even get prime less if they really are a good client. But generally, it's an individual thing. There's you can't link the interest rate to an 80% bond or a 90% bond. It's really client related.
So disposable income is important. The second thing that creates risk for the client is what? What are the things you see that comes into play when a client probably has met disposable income, but what are the other issues as well?
The other issue could be the way the client conducts his credit accounts. So you might be a client that has got good affordability, but then his payment profile, that's where a bank picks up a problem. For example, if he pays late on any of his retail accounts or his credit cards or any of his bank products that he might have in place already, then that automatically reduces his scoring. So you might have good affordability, but as his scoring comes down, the bank looks at him again in risk. So even if his affordability is high and his credit score is now low because of poor conduct on his accounts, then again, the bank will reject or make a lower offer.
In your assessment with different types of clients, obviously there are some that are single, there are some that are families or households of couples with children. Who are the category that mostly get their loans, and what do you think is the reason why that category gets most of their loans?
The ones that seem to be most successful, if I look at the area that we are in, is the age group from mid-30s to mid-40s.
Okay.
Because they are professional people, they've established themselves in their careers, they've got a good credit history, good credit track record, and they seem to be the most successful, and that seems to be the market that's moving the most. The age group above that is the easier one for them to move on because they might have an existing property that they sell, and the funds and the proceeds from that existing property they utilize to either go into a retirement village or into a smaller complex or a smaller property. But most of the movement and success seems to be in that middle age group. The younger ones still have to build up a bit of credit, a bit of a track record. So that's where most of our buyers are being successful, in that age group.
So when you look at these types of groups, is there any type of housing that seems to be cropping up that you are dealing with most often? For example, sometimes people are looking for flats, or sometimes people are looking for full houses. What type of house seems to be cropping up within your area that you are working with?
Well,
what are the reasons?
I would say in our area it's a fair mixture of all of those that you've mentioned. It depends very much on the client's need. For example, a young family might start with a flat, and then an older family with children will want a nice conventional freestanding house in a nice neighborhood, and then the older ones would move, maybe, like I said earlier, to a retirement village. So there's no specific type of property that we can say in our area that stands up head and shoulders above anything else. It's a very even spread across the market in our industry.
Then I want to go to a section where we talk about mistakes that you have seen people make, because obviously you've been in industry. What is it that you can tell somebody who's going to apply for a house to avoid doing, so that they don't make mistakes that ends up leading them into either high interest category or being rejected outright by the bank? What are those things?
So one of the biggest things that we pick up with a lot of clients is they will take out what we call a payday loan. So their salary doesn't cover the expenses for the month, and you get these short-term loans that's the filler from the middle of the month to the end of the month. Then when your salary comes in, you have to pay that back, and then it becomes a cycle. That's a big red flag for the banks. Immediately it's an outright rejection. The banks are very nervous of that kind of client, so they stay away from that. So the biggest problem is how the client manages their credit. Also, what we do tell our clients, and it does happen from time to time, is when you receive your bond grant, if it is positive and the bank grants you, then do not make any debt after that. Don't make new debt or new credit. Very often they do. And what the banks do now is, before the property registers or transfers in the deeds office, they do a review of the client's credit history and credit status. Now they pick up the client, for example, has bought a new car because he wants his new car to match his new house. And now suddenly his affordability is now coming into question, and the bank withdraws the bond, causing the client to be unsuccessful. And of course it has a knock-on effect, because now the seller has the idea that his property is already sold. But now the bank pulls the purchaser's bond, and then both parties end up losing out. So it's things like that: managing credit, avoiding payday loans, not making any new debt after being successful in the bond application. That are the challenges that can derail the process once it's started.
Okay. You have been in the industry of this nature for a long time. Obviously, people will need to learn from you, and you have picked up a lot of experiences to get to where you are. What would you tell a new and young upcoming person, knowing what they are doing, the young ones do now? What is it that they can do to be successful in their financial life? From when they leave school to when they start getting a job and managing their own money. What is it that they can do? What are they making mistakes on?
Well, I think the biggest mistake that younger ones make when they start out is they don't start out with a budget. So they don't plan their finances, they don't plan how they're going to invest, and they don't have so the long-term goal would be to buy a property, but you've got to have your short-term goals in place. This is how much I earn, this is how much I'm going to save, this is how much I'm going to dedicate towards the property that I'll own one day. So it's lack of planning. And it's also, I think it's human nature. We have this thing in us that I'll look after today, tomorrow will be tomorrow's problem. And I think that's the big challenge that many young ones have. And because of the uncertainty of economy and lack of employment, we can understand why people might reason that way. That, I'll just, if I get through today, I'm fine for today. In 10 years' time, my situation hopefully will have changed, but it doesn't work like that, we know in life. You have to have a dedicated plan. It starts with a budget, starts with what kind of property you'd like to see yourself in within 5 to 10 years. Save money for that, because the minute you have a deposit available and you can present your bond application with a deposit, immediately the bank changes their view of you. It can be the difference from an outright decline to, well, actually this client has work, let's see what we can do to help him to get a bond. So those are a few things that I would advise young ones to do, just to sit and think about where they want to go, budget and plan.
So you're talking about looking at the future,
Yes.
rather than just focusing on today's needs, today's bread, and just being able to plan, have a budget and manage your finances well. So when the bank looks at your history, they find it making sense.
That's correct. But it is based on the experience in this area, and I think if you speak to different people from different markets or sectors in South Africa, different geographical areas, you might find a totally different response. But that's certainly what we're experiencing here.